This may be the biggest hidden gem to ever be traded on the stock market for 2023. What's going on, folks? Welcome back to the channel. My name is Leo. I'm a value investor, and in today's video, we're going to be investigating what I believe is a value investor's dream. This company here actually trades on the Toronto Stock Exchange. It's called Parex Resources. Without further ado, let's jump into it. Take a look at this. Currently trades at around $25.04, and 52-week range jumps from 17 on the low end to 30 on the high end. But take a look at this price to earnings ratio, folks. We're going to jump into the financial valuations in a minute. Bring our attention to the price earnings ratio. Currently, it is at 3.74. We're on average at 8.38. Those two numbers there, folks, are extremely low. We love finding companies below 22.5. Even below 15 is like, or even around 15 is usually the market average. Below that, we are in immediate undervalued territory. Now, we shouldn't just use that one metric as a deciding factor, but something to keep in mind, folks, and I'll bring you back to this page. Currently, our price earnings ratio is 3.74, and our EPS for the trailing 12 months is 4.74. So we have an increase in EPS over our 5-year average and a decrease in our price earnings ratio on our 5-year average. Couple that with a solid return on equity compared to our 5-year average. So they've been making improvements on all these different things while the price earnings ratio goes lower. These are the numbers we love to see. An increase in profit margin compared to our 5-year average. This is something we'd like to see. Now, hopping over just for a quick second to the financial evaluations. What this software does, it takes a look at the company's last 5 years, grades it out of 10, and to give us the financial strength of the business that we can utilize to say, okay, what are the trends? Where can we expect this business to go forward? And is there any problematic areas? Well, one of the things that they are getting wrong, or they're getting a point docked for, is the current ratio, currently sitting at 0.99. Now, we can call that 1, and that ultimately what that means to us is that they have just enough assets on hand to cover those liabilities, but essentially makes it nil. So in a case where you are in a troublesome scenario and you have to liquefy or get some liquidity involved, you don't have any margin of safety. The software prefers, and frankly myself as well, a current ratio of 1.5 and higher. Now, ultimately, 1 to 1, it's not the worst thing in the world, because if you look at everything else that's going on, here are the other positives. The 5-year price earnings ratio, which we already discussed. The return on equity average sitting at 23.97. We love to see a trend of return on equity sitting above 15% on average, and 23.97 is great. An EPS growth of almost 450% over the last 5 years, phenomenal. An extremely low debt to equity. What does that mean, folks? They are funneling their operations through equity and not taking on debt. And we'll investigate the debt scenario in just a quick second. But I've never seen a debt to equity ratio that low before. So something to keep in mind. And here's the other thing, folks. The other caveat is usually when you see a low debt to equity ratio is usually when you see a lot of share dilution. But with Parex Resources, not so much. We are down by 9% in share dilution. What does that mean? They've been buying back shares. This company's been so smart in buying back shares because they have to know their company's share prices are cheap. And we want to find companies that are doing that. We want to find companies that are not increasing the shares, buying back the shares when they're cheap, because that means we as shareholders own a little bit more of the pie, a little bit more of the business, a little bit more of the profits. Speaking of that, the net income is up, the free cash flow is up, and return on invested capital is sitting at 25%, along with revenue growth increased by 30%. And these are the numbers, folks. These are the numbers. I'm not ever going to sell you just a hype dream, but this is what this company's been doing over the last 5 years. And they've been ultimately super solid. So everything's increasing. The only issue is this current ratio, but I can live without that, considering everything else that's happening over here. Now, they also pay a dividend, a 5.49% yield. It's pretty high, but something to keep in mind is that works out to be $75 million being paid out to shareholders, where on average the free cash flow sits around $300 million. Currently, our free cash flow is in the negatives for the trailing 12 months, but I don't think it'd be an issue considering obviously we have to figure out what the year end looks like, but on average they're able to pay off their dividends no problem with this 300 million that they have on average. There's a lot of good things happening with this business. As I said, we're going to talk about the debt scenario. I'm going to go to the balance sheets on the software. I don't know why the drop down menu, there's a drop down menu here. I don't know why it doesn't pick up in the recordings. Regardless, take a look at this. We're going to go to total debt, and it's $6.08 million, folks. 4.51. So they've been increasing the amount of debt over the last little while. But here's a great thing. It's so low. This is why their debt to equity is extremely low. And when you have so much free cash flow on hand that Parex Resources has, they can just pay it off just like that. So this is what you want to find. This is what you want to find, folks. You want to find companies that, hey, you know what? We have some debt. It's okay. We have so much free cash flow on hand. Just pay it off. It's not a problem. They can actually afford to take on more debt. And that's something that they might potentially want to do in the future. Maybe not so much now, considering the high interest scenario that we're currently in. So, you know what? Maybe I retract that statement. The fact that they don't have that much debt with the high interest scenario that we're currently in is a positive thing. Now, here's one main concern that you may have as an investor buying into this business. It's an oil and gas company. Now, look, here's the thing, folks. They do a lot of their operations in Colombia, and here's the facts. Oil is not going away anytime soon, despite what a lot of politicians want to have you believe and try to push towards this other green agenda. Because here's the fact of the matter. You're going to need oil for a lot of other things. It may not be gas, because we're obviously trying to go over to electric vehicles, but you still need it to make plastic. You still need it to make a lot of other components that we use on a day-to-day basis. And if that doesn't exist in this current Western world, there's a lot of other countries that still need oil. There's in South America, Africa. The fact that they're doing a lot of their operations in Colombia is saying to me that they're trying to corner the South American market. For me personally, do I think oil is going to go away in the next 10 years? Absolutely not. Absolutely not. And I think if anything, there might be a surge as all these other countries start getting on board. They start getting wealthier and start wanting, hopefully, to demand Canadian oil and not be buying oil from, let's say, the Russians and all these other manufacturers. That's my hypothesis. What should we be paying for this company today? Now, ultimately, that's the ultimate question. So what I'm going to do, folks, and if you're liking this video so far, hit that like button and subscribe button if you haven't done so for weekly videos. I analyze companies at least 3 times a week. What we're going to do, folks, is use another section of the software called the price analysis section. What I do here, folks, I'm going to input some numbers of what I believe this company is going to do over the next 10 years, staying roughly within a conservative basis of the historical growth numbers, profit margin, free cash flow, and all those other lovely numbers, and we'll figure out what we should be paying today. I'm going to fill out those numbers and we'll talk in just a quick second. Alright, folks, let me tell you what I did. So if you're new to the channel, I like to try to stay as conservative as possible, so I used some extremely low revenue growth numbers, some extremely conservative profit margin and free cash flow margins based off what they've shown historically. And I've kept the price to free cash flow and PE ratio also extremely low, doing 14, 16, and 18 for the price to free cash flow. And the PE ratio sitting at 5, 7, and 9. As I said, we're currently at 3.74. On the high side for the 5-year average, it was 8.38. So it kind of stuck within that realm. Current price is 25. Now I'm going to click calculate. This software is going to just crunch all those numbers and see what we should be paying today. But these revenue growth numbers are extremely low. And just to give you guys just an estimate of what's going on, I'll give you an analysis based off of Yahoo Finance. So current quarter is 33% growth. Next year, they're anticipating a 20% growth, 6.8. So I'm trying to go as the next 5 years, 10.16. So I'm trying to go as conservative, like trying to stick within those numbers and what they've done in the past. Obviously, past performance isn't indicative of future performance, but take a look at this. Current share price is $25.09. Currently, our average calculation comes out to be $125.84. Now, if I, let's say, a conservative average right there, $85 on the low end, that is like, you're buying this company for cheap. And I've also put a 13% return. What I'm going to do, folks, just for the sake of argument, I'm going to just put 3, 6, let's go 3, 4, 5. How about we do that? 3, 4, 5. Really small revenue growth going forward. Like, let's say this company just slows down as much as possible and continues to grow. Okay. Take a look at that. Here it is with Parex Resources. If you believe the low revenue growth numbers of 3, 4, and 5% going forward, you're getting this company extremely cheap. As I said, it's $57 where it's currently trading at $25. Now, I should come out and say I actually do have a stake in this company. I do have a position. Now, does that mean you should go out and buy this company because, oh, I own it? Absolutely not. You have to do your own research. Luckily for me, I have this software called StockSpec, and lucky for you, you can utilize this software as well for your own analysis purposes by following the links in the description box below. There's a 7-day free trial, and this software costs less than your Netflix subscription, and the difference is it won't waste your time, and if anything, it'll make you money in the long run. So those two features alone is worth it for me. So that being said, folks, is Parex Resource a buy? For me, it is. I'm going to continue adding to my position because I'm getting this company for an amazing discount, and I don't think this company is going away anytime soon, despite what the oil haters might make you believe. So folks, that's the video. If you found this video helpful, follow the channel, hit subscribe, hit like, and share it with a friend. I will see you in the next one. Thank you so much for watching.